Hello everyone, and welcome to this educational video on debit spreads and credit spreads. My name is Matt Williamson with SensaMarket, and we are starting here on the home page of option strategies. Oh my goodness, there's so many. There are so many. We are going to focus on these little guys right over here. Okay, these are all our vertical spreads. Okay, in options trading, especially when you're starting out, you're going to hear people talk about debit spreads, credit spreads, bull call spreads, bear call spreads, bear put spreads, and I believe bull put spread was the one I missed there. They are all just vertical spreads. Okay, and I guess just for a quick point of clarification, anytime we trade one option against another option or with another option, that is called a spread. Okay, if we just buy a call, sell a put, sell a call, buy a put, that's a single, and anytime we're doing more than one of those things together, it's a spread. Okay, typically the first few spreads we learn are debit spreads, credit spreads in the form of vertical spreads. Okay, all spreads, whether they're calendars, diagonals, straddles, yada, 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 they're all going to have a debit or a credit associated with them. So again, we are just talking about vertical spreads today. Okay, specifically, call spreads and put spreads, call verticals and put verticals. So we're going to start with the debit spread side of things here. Both of these types of spread are going to be entered with a debit. That's why they're often known as debit spreads. Okay, we're not going to pay to, or we're not going to get a credit rather to enter these positions. We're going to pay a debit to enter these positions. Okay, so let's start with a bullish call spread. Okay, that means we are buying calls and selling some other calls to pay for it. Okay, when we buy a call and sell a call at a higher strike, the one we bought costs more than the one we sold, and that gives us a debit. Okay, so for example, let's say we are looking at Tesla, which is currently trading around 264. We're just going to go in the money slightly. Let's pretend here for a second we bought the 240s. Okay, the 240s are going to cost us some amount of money. And then the 250s, for example, are going to cost less money because they're further out of the money. So if we buy the 240 and sell something above 240, we're going to buy the more expensive thing, sell the less expensive thing. So we're going to wind up with a debit. Okay, in this case, it's about a $14 debit for buying the 240, selling the 265. Okay, and the profile looks like this. Okay, we have losses below 240, below our long strike, and we have gains above 265. Obviously, we have some losses and gains in the middle there too, but our max gain is above 265 and our max loss is below 240 with a gradient of profit and loss in between. Okay, that's a debit spread because we paid a debit to initiate it. It's a bullish call spread. Okay, call vertical spread, aka also known as just a call spread, which is confusing because anything with calls is technically a call spread, but when you hear people talk about call spreads, they mean a call vertical spread. Okay, so if you hear quote unquote call spread, that means call vertical spread, which could mean a bullish call vertical spread, or it could mean a bearish call spread. I know it's a lot of stuff. It's a lot of stuff. Okay, let's take the other side of the debit equation though. Let's look at the bearish debit spread or bearish put spread. Okay, also known as a long put spread. I know there's a lot. It's a lot. All right, we're going to drag these strikes down just a little bit. Let's say we're still trading Tesla. And we'll go slightly in the money. So on the put side, Tesla's trading at 264. Let's look at a 270 put. Okay, that's about 6 points in the money or so. If we buy an in the money put and sell an out of the money put, well, we're going to wind up with a debit. We're going to wind up buying the more expensive in the money put and selling the less expensive out of the money put. So that's also going to result in a debit. Okay, so we can do a debit put spread. We can also do a debit call spread. Okay, we can set those up, puts or calls, so that they wind up with a debit transaction. Okay, in this case also, max loss is above the long strike in this case, so above the 270, and max profit would be below the short strike at 245. Okay, and there's that gradient of P&L in the middle. Okay, and both of those represent debits. We're buying the more expensive in the money thing, selling the less expensive out of the money thing. You can tighten them up as much as you want as long as the short is further out of the money than the long, you'll wind up with a debit. Okay, if you're buying the long and selling something that is further out of the money. Okay, on the credit side, you might not be too surprised here that it's the opposite. right? If we sell something that is in the money or at the money and buy something that is closer out of the money or further out of the money, as long as we have that kind of relationship of the short strike being closer to or further in the money than the long strike, then we're going to wind up with a credit. Okay, so a credit spread is just one of these verticals executed for a credit, meaning again that the short strike is going to be in the money or at the money or further in the money than our long strike. Okay, in this case, that would give us a bearish call spread. Okay, we'd be selling the 255, sorry, brain fart, and buying the 275. Okay, we can also do a bullish credit spread. In that case, we are selling the 265 and buying the 240. Okay, one easier, maybe not easier, but maybe easier way to kind of visualize these things. You know, let's pretend we're selling a naked put on Tesla, where we're selling a put at 265, obligating us to take the shares at, 275, obligating us to take the shares at 275 if Tesla finishes below that. This little guy over here is just protecting us in case something chaotic happens. Okay, if Tesla trades down to 120 over the next few weeks, like this guy kicks in and helps. Okay, and it is a credit spread. It is a vertical spread. It is a put spread. This little 120 put over here is just probably not getting out on the playing field. If it's way up here, yeah, it's probably coming out there to play. And this is still the same trade. It's just less wide. Okay, this one's a really wide version, same trade, short put spread, short vertical spread, bullish put spread, bullish credit spread. You know, all those different names apply. That's just a much more narrow version. Okay, and ultimately, where you want to go as a trader, you want to be calling these things short put spread, short call spread, long call spread, long put spread. Okay, long means I paid a debit for it. Short means I sold it for a credit. Okay, a long put spread is a put spread, a vertical put spread that you paid a debit for. Okay, it's a debit put spread. That's a long put spread. Okay, a long call spread, debit call spread. Short credit spread, short put spread, this guy here. Short call spread, this guy here. If you want to be really specific, you can call it a short call vertical. That is a little bit more descriptive. Okay, technically we could have a short call calendar spread, but almost always you'll hear people say the word calendar. It will be, oh, I did a short put calendar spread. If it's just I did a short put spread, that is a credit put spread. Okay, it's this guy right here. So if you're trading and sort of working your way into options and finding your way into that universe, first of all, thank you for coming to Sensa. It's a great place to do that. Tons of tools that you don't have access to otherwise. And then also on the lingo side, start referring to those bull put spreads as a credit put spread or a short put spread. Okay, either of those are a little closer to the lingo in use. All right, that's going to do it this time. Thanks for tuning in, and we'll catch you on the next one. Take care.